Welcome to This Explainer. So, imagine for a second that you've got the greatest business idea in the entire world. I mean, maybe it's this revolutionary app that's going to totally change how we learn, or a super cozy neighborhood coffee shop, maybe a cutting edge clothing brand, or literally the next billion-dollar tech giant. You've got the vision, right? The passion, the drive. But, well, there's just one massive problem staring you right in the face. You have absolutely zero money. None. So, can your brilliant business actually survive? Today, we're diving straight into the secret engine behind literally every single successful business out there. We're talking about financial capital. All right, let's get into it. Look at the absolute titans of industry today. Where do companies like Apple, Tesla, Starbucks, and thousands of other highly successful startups get the billions of dollars they need to operate? I mean, is it magic? Is it just pure luck? Do they simply rely on having wildly rich owners from day one? The answer is an emphatic no way. Every single one of them, without exception, relies on financial capital. Let's ground this in reality for a second. Imagine two friends. Ollie wants to open an incredible new burger restaurant, and Sarah wants to create this highly innovative educational app. Both of them have amazing ideas, and both are incredibly hardworking. But here's the harsh reality. Neither of them has enough money. With zero cash, can they buy kitchen equipment or computer servers? Can they rent a building? Can they hire even a single employee or run an ad campaign? No, their businesses literally cannot even begin. Having a revolutionary idea but zero cash means you're stopped before you even reach the starting line. So here's our quick roadmap for today's masterclass. We'll cover the billion-dollar problem, what financial capital is, why businesses need it, the sources of that capital, and some real-world examples. Finally, we'll wrap the whole shebang up with some crucial AP exam tips. Okay, section 1, the billion-dollar problem. Because sometimes ideas just aren't enough. The absolute most crucial point here is summarized perfectly by this. Without money, ideas remain ideas. Take a moment to really let that sink in. A business simply cannot begin without resources. It honestly doesn't matter how badly you want it or how unbelievably smart your concept is. If you cannot fund the operations, your grand vision stays permanently trapped in your imagination. Moving right along to section 2. What actually is financial capital? By definition, financial capital is the money available for businesses to invest in operations and growth. Now, I really want you to remember this specific phrasing. It's the money used to buy resources. Money itself doesn't magically produce products, right? You can't just plant a dollar bill in the dirt and grow a coffee bean. Instead, financial capital is the fuel used to purchase buildings, machines, technology, inventory, and of course to pay for your marketing and your employees. Now, you absolutely must not confuse these different types of resources on your exams. Financial capital equals money. This is totally distinct from physical capital, which is the actual equipment and machinery. It's also distinct from human capital, which are your workers, natural resources like land, and entrepreneurship, which represents your actual business ideas. Let me give you a fair warning right now because students mix this up all the time. Financial capital is, well, actually, let me be super clear. Financial capital is the money you use to buy the physical machines. It is not the machines themselves. All right, section 3, why businesses need it. Let's look at the growth formula. Think about this. What happens when a small neighborhood cafe suddenly goes viral on social media and doubles its customers overnight? They run right into this beautiful growth formula. Let's say you're opening a bakery and you secure AED 250,000. That money kicks off a crucial cycle. Step 1, you have the financial capital. Step 2, you make an investment. You buy more tables, you hire extra staff, you secure more ingredients. Step 3, this allows for expansion, letting you actually serve double the customers. And step 4, that expansion directly leads to higher revenue. Businesses need financial capital to start operations, develop new products, survive sudden emergencies, and ultimately expand globally. Without it, growth is just mathematically impossible. Which brings us to section 4, sources of capital. Where in the world does all this money actually come from? Let's explore the 6 major sources of funding, and crucially, their trade-offs. First up, we have personal savings. The brilliant benefit here is that the risk is lowest to outside parties, and you keep 100% control. The downside? Well, you're obviously limited by whatever's in your own bank account. Second, bank loans. You get immediate money, which is perfect for quick expansion. But the risk is you absolutely must repay it with interest, regardless of whether your business succeeds or fails. Third, we have investors. They give you cash and often bring incredible industry expertise, but the trade-off is heavy. You lose a percentage of ownership and control of your own company.
Now let's look at the next three. Fourth, selling shares. This is typically for larger companies raising millions from public investors. But again, you're selling pieces of your company. Fifth, crowdfunding. This is when thousands of everyday people contribute small amounts online, an absolutely amazing tool for highly innovative modern ideas. And finally, government grants. Sometimes governments just give money to support things like green technology or small local businesses. And wonderfully, these often require no repayment at all. Remember, every single source has its own unique benefits, risks, and costs.
Section 5. Real-world examples. Let's see this capital in action. Let's step out of the textbook for a second and into the real world. Check out these massive corporate trajectories. Amazon? Jeff Bezos basically built that colossal empire starting with his own savings and some initial investments from his family. What about Tesla? They had to build these massive, state-of-the-art car factories, so they raised absolute billions directly from outside investors. Starbucks fueled their insane global expansion by carefully combining their own retained profits with external financing. And consider a local Dubai restaurant. It might start with family savings to open the very first location, secure a bank loan to open a second, and then use retained profits to open a third. The huge takeaway here is clear. Every single stage of a business requires a new infusion of capital. All right, Section 6, AP exam tips. Let's test your knowledge to make sure you're ready. Here's a classic question format you are very likely to see. Think carefully about what we just learned today. Which resource allows businesses to purchase machinery? Is it A, natural resources, B, financial capital, C, human capital, or D, entrepreneurship? Take a second and lock in your answer. And the correct answer is, of course, B, financial capital. Huge congratulations if you got that right. You remembered our critical warning from earlier. Financial capital is the money used to buy the physical capital, like machinery. Excellent job. Let's do just one more to test your critical thinking regarding those trade-offs we examined earlier. Why might a business prefer investor funding instead of taking out a bank loan? Think about the immediate cost of a loan versus bringing on a partner. The answer is because investors usually don't require monthly loan repayments. While it's definitely true that you have to give up some ownership and control of your company to an investor, doing so absolutely frees your new startup from the crushing burden of immediate monthly interest payments to a bank. It's a highly strategic trade-off. So as we wrap up this masterclass, I want to leave you with 3 essential steps for all you future entrepreneurs out there. Step 1. Know exactly how much money your business actually needs. Step 2. Choose the absolute best funding source based on those trade-offs we discussed. And step 3, use your financial capital wisely. Never, ever forget that money alone doesn't magically create success. It's the smart, strategic financial decisions you make with that money that will ultimately build your empire. And I'm going to leave you with this final, provocative thought. If you started a business today, right this very second, where would your financial capital actually come from? Would you drain your personal savings, go pitch to investors, or maybe try your hand at crowdfunding? Think about it. Share this explainer with your classmates who are preparing for their AP business exams, and be sure to stick around for more deep dives into the secret engines of the business world. Keep learning, keep planning, and I will see you in the next one.